I also want you to think about how important is real estate investing to you. If it's something you really want to get started on and it's a high priority for you, you're going to have to be ruthless with your priorities. You're going to have to cut out some stuff that maybe doesn't make the cut. It's not as important as real estate investing. So how much time do you need to carve out specifically? You need at least 10 hours per week in order to give yourself a minimal chance of success. Welcome to the Real Estate and Financial Independence Podcast. I'm your host, Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. Whether you're a brand new listener or a longtime listener, thank you for being back for another episode. Today's episode is another in the series of the Best of Coach Carson podcast, and this one is called Real Estate Investing 101, How to Get Started or Restarted. So this is another episode that was one of the top downloads from the archive. It's actually number 2 all-time downloaded episode. And so this is really for any of you who are either new to the investing world or maybe you're stuck and you're just trying to get back in. Maybe the market's changed and you haven't figured out how to get back into the market. You already have a couple of rental properties. This will take you through step by step. And I'll warn you, this is a comprehensive episode. There's a lot of detail, but I hope you find it helpful. I also have links in the podcast description to some of the resources that I talk about in the episode. You can look there. There's a companion article that you can read. You can get a free course that's included with this episode. So lots there. Hope you enjoy it. I want to start off by giving you the motivation for me providing this episode for you. And it goes all the way back to when I was a brand new real estate investor. I was a 23-year-old, pretty much a kid. I'd just gotten out of college and I had zero experience in the business world or pretty much the real world at all. I paid for college with a college scholarship, gotten a college degree, but it was time to jump into the real world and figure out, all right, what are you going to do to make a living here? And what are you going to do for the rest of your life? And so it was a little overwhelming when I first got started. The only thing I knew to do at the time was to learn as much as I could from books, from seminars, from mentors, and from the school of hard knocks. Every time I made a mistake, my business partner and I would agree to turn that into a kind of a real world seminar and write down our lessons. So all of that was great. But sometimes I learned that more education as a new investor isn't always the right answer, at least at first. As you learn more, what happens is you suddenly become aware of the many choices and the challenges that you have ahead of you. So ironically, knowing too much about a subject can sometimes lead to analysis paralysis. Maybe you've also experienced that. So if I could start over again, I would begin, yes, with some education, definitely important. Obviously, I write a blog and have a podcast about educating you on real estate investing, but I would also have the framework of that learning that you would do and that I would do as a beginner. I would have a step-by-step plan from a more experienced real estate investor. So there'd be some organization to that learning instead of just learning from here and learning from there and listening to all these different podcasts. I would have a little bit more organized approach. And this plan would allow me to learn in stages while still moving forward. And it would help me focus on the essentials while ignoring the inessentials. Or the unessentials. Not sure which one of those is correct. But by following those steps that I would have in the beginning, I would have saved a lot of time and a lot of frustration and avoided becoming overwhelmed. So I can't go back for myself at the very beginning, but I can create a step-by-step plan for you and use my experience over the last 17 years in real estate investing to provide you a framework for how to get started. And so that's really what this episode is all about. And I hope you find it helpful. So the rest of this Real Estate Investing 101 Get Started Guide episode is organized into 9 steps. And I recommend following these chronologically. They're designed to be done one after another, but it might be that you've already done some of these, that you have 1 or 2 mastered and you need to focus on the other and find your gaps. So whatever works for you, that's great. But I do recommend these are typically done in a chronological fashion in order to get the most out of them. So here are the 9 steps that we're going to go through. Step number 1 is to identify your financial stage. So it has nothing to do with real estate investing. It has more to do with your wealth building and your finances. Step number 2 is to choose a specific real estate investing strategy. This is where a lot of people get hung up. They go from one strategy to another instead of picking one. So I'm going to try to help you do that. Step number 3 is to pick a target market. So the place where you're going to be investing. Location, location, location. That's a mantra in real estate investing and real estate. And that's important here as well. Step number 4 is to decide your investment property criteria. So basically the numbers. What does it mean to have a good deal for you? Step number 5 is to build your team. Real estate's a team sport. You can't do it alone. Step number 6 is to line up your financing to get the money to buy your deal. Step number 7 is to raise cash for your down payment and reserves. Typically, you need to have some of your own money, some of your own skin in the game. And so I'm going to talk about how to raise that money and how to find it. Step number 8 is to create a plan to find deals. It's number 8, but that's probably one of the most difficult steps for a lot of people. So I'm going to talk about how do you find deals to buy and how do you create a budget to maybe spend a little bit of money to find some deals. And then step number 9 is to schedule your time and prioritize next actions. It's basically taking all those other concepts and turning it into an action plan that you can schedule and do on a day-to-day basis. So you're going to get summaries of each of those steps below. But as I mentioned earlier, I'm going to have a lot of links here to other articles if you're reading the companion article, or I'm going to reference other podcast episodes. So definitely take some notes, and this is going to be something you go back and listen to and dig in a little deeper with whichever one of these steps you need the most help with. All right, let's get started with step number 1. And step number 1 is to identify your financial stage. Real estate investing is really a vehicle to improve your finances. So we focus a lot on the nuts and bolts of real estate investing, but the bigger picture is you're doing this primarily to make more money, to build more wealth, to improve your financial picture. So before we get into the details of real estate and getting started in real estate, I want us to think about your overall financial picture. So most new investors, at least the ones who listen to my podcast, are sort of shooting for a big picture of financial independence. And you can go back and listen to episode number 53, where I talk about what it means to have financial independence and how there's a lot of milestones along the way. So the peak of the mountain might be having your rental income or a combination of other investment income covering all of your personal expenses. That's sort of a basic definition of financial independence. But there's also a lot of milestones along the way. So you don't have to wait until you get to the peak of the mountain to actually experience some of the benefits of financial independence or an early retirement. Now, the fundamentals of climbing this mountain towards financial independence are the same whether you are a real estate investor and use that as your primary vehicle or use any other investing vehicle. The fundamentals are that if you want to climb the mountain faster towards financial independence, it has one main strategy, and that's to increase your savings rate. So you've got to save money. You've got to earn more. You've got to spend less, and you've got to create this gap between your earning and your spending so that you can save money. That's sort of a prerequisite. That's got to happen. You can use real estate to help you do that. Maybe you have as a side hustle and you flip some houses on the side. You do some wholesaling. But eventually, if you want to plant seeds and build wealth, you've got to have those savings. You can't do it with no money down forever. You've got to actually create some equity and save some money. So I just want to mention that as a prerequisite no matter what we're doing. And I also want to mention with your big picture finances that all of us are going to be at different stages of climbing towards financial independence. Some of us, and I actually call this your wealth stages. And if you want to go look at a more in-depth definition of your wealth stages and see some images of what these look like, then you can go to back to my episode number 13, Real Estate Investing for Beginners, where I talk a lot about wealth stages. But I'll briefly go over them again here and what they are. So stage number 1, and these are just my definitions. You can kind of redefine these for yourself if you need to. But step number 1 is survival. Stage number 2 is stability. Stage number 3 is savor. Stage number 4 is growth. Stage number 5 is income or withdrawal. And this really has to do with kind of how much net worth you have. If you're in the survival stage, you might be negative net worth. You're just trying to get the bills paid. You're just trying to dig yourself out of a financial hole. And, everybody's been there. We all start from ground zero unless we were a trust fund baby, which you're probably not listening to my show anyway. Most of us had to start from the beginning and start at the bottom of the mountain. So if you're in survival right now, I'm going to talk about some strategies that can help you at that stage. But the point here is you need to know where you are, because your approach to real estate investing is going to be very different depending on if you're in survival stage or if you're in stability where you have a nice emergency fund and some debt paid off, or if you're a saver where you're increasing your savings rate and you're doing pretty well with that, or if you're in the growth phase where you're actually turning your net worth from a small nest egg into a big nest egg, or if you're in the final stage, which is where you already have a pretty significant net worth and you're trying to turn that net worth into income and stable, kind of a stable portfolio for an early retirement or a regular retirement. So the point here for right now is for you just to think about it and say, based on what I just described, or based on listening to episode number 13, which stage do you think you're at? Are you at the very beginning, kind of down in the survival stage? Are you closer to the top, or are you somewhere in between? That's going to be an important distinction, and you don't have to be perfect with it. Just sort of think about it for now and just decide in your own mind as we go through the rest of the steps, which one of those makes the most sense for you. All right, so you've got a rough idea in mind of whatever your wealth stage is, or at least you've taken a note to go back and listen to episode number 13 and sort of dig into that topic a little bit more. So as we advance from there, we're going to go to step number 2, which is choose a specific real estate investing strategy. Now, at this stage, it's really easy to get bogged down. And remember, I talked about analysis paralysis, where you have so many things going on in your head. You could create a 30-page business plan and go into every single detail and get it all figured out in the very beginning. But remember that the goal here is to just get started. And sometimes being imperfect and starting is better than having it all figured out, because things change. You have to adapt once you get started. So let's think about something that can help you get started a little bit quicker. And if you want to still create a big detailed plan later, that might be good. That might be good to kind of adapt things and figure out what you're doing. But sometimes I find getting started is even better. So for now, the goal here in this stage is to choose one real estate investing strategy that will help you move from wherever you currently are, your current financial stage that we talked about in the previous stage number 1, that we're going to try to get you to move from that stage and to start moving forward. Starting with one specific strategy doesn't mean that you won't have detours, doesn't mean that you can't completely change your direction later on. Life happens, business happens, and one of the hallmarks of successful entrepreneurs is to be flexible. But starting and focusing on one is really important, and it's going to help you have the confidence to get started and kind of get over that overwhelm stage. So what I'd like to do here is to give you a menu of suggested real estate strategies that you can choose from depending on whatever wealth stage you chose in the prior section. All right, so let's talk about strategies for wealth stages number 1 and number 2. And just as a review, those are wealth stage number 1 is survival, and wealth stage number 2 is stability. And the way I define those really briefly, survival is if you're in the place where your top priority is just getting the bills paid. You might be digging yourself out of a financial hole. You might be just starting as an adult, just trying to get some bills paid. You might, whatever your situation is, you don't have a lot of savings yet. You're kind of just in that week to week, month to month stage. And if you're there, don't beat yourself up about it. We've all been there. That's okay. So I'm going to talk about some things you can do with that. And stability, I define as just moving up a little bit from that, where you have a little bit more financial oxygen, and perhaps you have an emergency fund, a little bit of cash in the bank just to kind of give yourself some cushion. And hopefully you're getting a job and some stability with a career or some kind of business that can help you pay the bills. That's more where I consider stability. And so I have some goals and some strategies that work for both of those stages. But just keep in mind that your goal here financially, whether you're in stage number 1 or stage number 2, is to earn extra income. That's a big part of it. It's to learn. So with real estate investing in particular, one of your biggest goals here is just to learn. You want to earn some money, you want to learn, and you want to avoid losses. Because at this point, you don't want to slide back and have some big negative movements financially. You want to avoid losing. And so here's a few different strategies that I think would be good for you to choose from if you're at this stage. The first one would be just to keep your day job and work to get a raise and do better with your current job. So that's not real estate specifically, but it would probably be the first strategy that I would explore. I'm not one who thinks just because real estate's amazing that you have to use it to do everything in your wealth building and your financial journey. If you have a good job, if it's stable, if it has potential for growth to make more money, very often just earning more money with that job is your number one asset. So I would recommend just focusing on that. And you can still learn about real estate investing on the side while you're getting out of the survival and the stability stages. Another approach could be that you have to live somewhere. So instead of simply renting or trying to stretch to buy a home and spend more money than you really have at this stage, I recommend doing something called a master lease. This is where you actually go out and rent a property from someone, and then you either sublease out the bedrooms. So let's say you could rent a 3-bedroom house, and of course we need to get permission from your landlord to do this. And there are definitely some landlords, if you build some trust with them and tell them what you're trying to accomplish and you show you're responsible, they might allow you to sublease out your bedrooms. So you could do that. You could also buy or rent maybe a duplex apartment and maybe convince them that you could help with the management and you could sublease out the other unit. So that if you've never heard of that, it's called a master lease or subleasing. There's a lot more details of that. I have a link in the companion article to a YouTube video where I describe that in a little bit more detail. And hopefully if that's a technique that some of y'all are interested in. I've done that some in the past, and I would be happy to kind of talk more about it, maybe even do a whole episode on it. But for now, look at the companion article and check out master leasing. It's a way to get into a property, reduce your housing expense, save more money. Because if you have $500 a month coming in from your roommate and your lease is $1,000 per month, you've just reduced your housing payment by $500 a month. That's a big deal when you're in the survival or the stability stage. So another idea for those of you in stage 1 or number 2 is to actually start a side hustle or a full-time career within the real estate investing business. And so there's a few different ways to do this. And if you just think about the different roles of real estate investing, finding deals, managing properties, managing remodel projects, all of them have people who are making money to actively do parts of those jobs. So you as a person who's trying to learn the business and earn extra money could get involved in that either part-time or full-time. And that's actually how I got started, was in the very, very beginning when I first started as a real estate investor right out of college. I really wasn't investing any money because I didn't have any money to invest. And so I got into the business of being what's called a bird dog. And this is that's a term that means there's hunting dogs, and this is where the term came from, who would help their bird hunting humans to go out and they would just go point at a bush where there were birds. And then the hunters would know that, all right, that's where the quail are. We're going to go shoot those quail and take them home for dinner. Well, very similarly in real estate, you can have a bird dog who doesn't know what to do with those deals that it finds. And I didn't know what to do with them at that point, but I could go talk to people and do some marketing and, spend my time and energy going out sniffing around to find good deals and then pointing at them and then making a fee every time this more experienced investor bought them. So that's one way. It's kind of a specialized niche of wholesaling, if you've ever heard of that, where you're buying low and selling a little bit higher. But you would typically have a real estate license and be sort of a specialized deal finder for investors. So that's one thing you could do to make some extra money on the side. You could also, instead of just becoming a specialized deal finder for real estate investors, you could have your real estate license and be a buyer's agent for anybody. You could help first-time buyers go out and find their house. You could be an assistant to a very experienced agent in an office and kind of make money with them. And so just getting your license and getting into the business of becoming an agent is another way you can learn the real estate market. You can learn how values work. You can learn how transactions work, and you can make some money in the process. Now, that is not real estate investing in and of itself. It's an entirely different business related to that. But you could get into real estate investing on the side after becoming an agent. I think that's a really good way to get into the business, especially if you're in the survival or stability stage. Similar to that, you could be a leasing agent or who could help basically find tenants for property management companies. So if you're really interested in getting into the rental side of the business, I recommend that, because leasing properties is one of the most challenging parts and most of the important parts of being a property manager or a landlord. So if you can learn that part of the business early on and make some money, maybe you can make $500 or $1,000 every time you helped land a tenant in a property, and you do this for a property manager or maybe just an individual landlord. You'd learn a lot, you'd make some money, and you'd do it without having to own rental properties. A final way you could do this is just another idea, is you could actually help to manage or supervise remodeling projects for other investors. So this is a little bit more of a specialized niche, but there's some fix and flip investors or some big buy and hold investors who do a lot of volume and a lot of projects. And if you're a dependable person who is interested in the construction business and remodeling, you might be able to be the person on the ground for them, supervising what's going on, being on site, checking out things for them. And that could be a really helpful thing for them while you earn a little bit of money and learn how that process works. So the point is here, you are using what you do have, your time and energy, and you're leveraging what you don't have, which is the ability to go out and invest in the properties yourself, but you're doing that while making money and learning. So all of those are strategies I would recommend for getting started in stages number 1 and number 2. So now let's move on to stage number 3 and some strategies that I would recommend for you. And remember, the stage number 3 is called Savor. And your main financial goal at this stage is to dramatically increase your savings rate by reducing your expenses and or increasing your income. Remember, that's the number 1 method of achieving financial independence is saving money. And so in this case, I'm going to talk about how can you do that by using real estate investing. So I'll start off by saying any of the options I just covered for the people in stage number 1 or number 2 could definitely apply here. So if you want to get a job working within the real estate investing industry, if you're a leasing agent or a deal finder like a bird dog or being a buyer's agent, or just keeping it simple and increasing your income at your current job, if you have a lot more options and potential there, then great. Typically, people get into side hustles in real estate investing because there's a ceiling on how much they can achieve in their regular job, or they just much prefer it personally. You really enjoy working actively in the real estate investing business. So if either one of those are true, or you need to make more money in the real estate, or you just enjoy it, then definitely get into a job doing something within real estate investing. So all of those that I just talked about apply. But additionally, because you're in the saver stage, there's a few more more hybrid investing options that I like to talk about that are now available to you. Number 1 is house hacking. So I'm a big fan of house hacking. You can go back and listen to episode number 9, where I talk all about house hacking and how to do it and what the approach is. But in a nutshell, house hacking means you turn your home where you live, and you typically buy a home, although the master leasing that I talked about in the prior stage recommendations could also be a form of house hacking, where you lease a property and then sublease out bedrooms, or lease a duplex and sublease out that. That's also house hacking. I just kind of did that in disguise in the last one, didn't call it that. But house hacking means that the place you live in also generates income. That's the kind of nutshell definition of it. There's a lot of different ways to do that. Some people live in a house and rent out bedrooms. Some people live in a duplex, rent out the extra unit. Some people live in a house that has a garage apartment and rent out the garage apartment for income. My wife and I we haven't done house hacking for a long time, but we found that our house is just too big and we want to use some of the extra space. We have a basement apartment and we're going to rent it out on Airbnb kind of during game day rentals for a lot of the Clemson football games. So that's another option. So there's all sorts of options for house hacking. So if you're interested in that, this is an awesome technique at this stage of the game because your goal is to save more money. And house hacking reduces your housing expense, which means you can save more money. And you can also, if you keep that property, end up having an investment that generates income and wealth building for you for a long time. All right, so dig into house hacking if you're interested in that. There are also some cousins to house hacking where you can either flip your residence, or if you're not interested in renting the residence out while you're there, you could live in a more modest house that eventually could become a rental. And then once you move out, you could turn that into a rental. I call that a live in, then rent. So you could live in and rent and do that, or you could live in a house and fix it up, increase the value of the house and flip it and turn that into what's called a live in flip. So a live in flip is where you just generate big chunks of cash on the back end. And there's a really awesome tax savings angle there as well, where you can not pay any taxes on it up to a certain amount of money. I think it's $250,000 for an individual and $500,000 for a couple, at least at the time I'm recording this in August 2019, for people living in the US. So live in flips, live in then rent, house hacking, all ways that are great for people in the saving stage to get started in real estate investing. And those three are probably the most common ways people do their first deal, is by turning their residence into some kind of investment. So definitely consider those. That's how a lot of people get started. If those aren't the right fit, or maybe you want to do something in addition to that, you could also consider a business of wholesaling. So wholesaling basically means you are finding deals for other investors and you get them under contract, or you go ahead and buy them, and then you turn around and quickly resell them for a usually a smaller markup, although you can have some pretty big markups as well. So the business of wholesaling is a whole nother topic, something we could get into in a lot more depth. But typically the people who are good at wholesaling are also good at sales. If you're used to getting rejected 20, 30 times and you're okay with that and you can keep on going and you see the big picture and you see that there's some value on the next, kind of to keep moving, then I think wholesaling could be something for you. But it's not for everybody. It's kind of positioned. I don't like that as something that is anybody can get started doing wholesaling. It's much more for the personality types who are good at making offers, or who are hungry and willing to kind of be a little bit more aggressive and going out to find deals. Another thing I would add, kind of the final strategy to think about if you're in the saver stage, to start a non-real estate business or a non-real estate side hustle. A side hustle just means you have a full-time job and you start a little entrepreneurship business on the side. And there are all sorts of possibilities out there. You can see a link to a friend of mine, Nick Loper, has an awesome list at sidehustlenation.com of a bunch of different options for different ways to get started with a side hustle. But this is, again, you don't have to use real estate investing during stage 1, 2, or 3. If you have a job or another business or a side hustle that makes more money, the only goal here is to increase your income, decrease your expenses, and save more money. And if you're doing that, then you're making progress. Real estate is just a technique to do that. All right, so let's move on to strategies for wealth stage number 4. We've talked about 1, 2, and 3. This is stage number 4, which is growth. So you're in this stage if your main goal, your main focus and priority is turning your net worth, which is typically smaller at this point. Maybe it's $25,000, $50,000, $100,000. You have some wealth built by being a saver, but now you're trying to turn that into a much bigger net worth. So you're kind of in the pure investment stage at this point. So here's some other ideas. You could use any of the stuff we talked about before, so everything applies, but you could also start a business perhaps of fixing and flipping houses. So this is definitely a business, not necessarily an investment. You're going to have to get involved as an entrepreneur, but it is a way to generate big chunks of cash that could help you grow. You could do this on the side perhaps if you have some time and enjoy remodeling, enjoy punch lists and kind of managing those. They are a lot of work. They're not always as easy or as fun as you see on HGTV. But this was the way that my business partner and I transitioned from being kind of the bird dog wholesaler kind of person. We started buying the deals ourselves and fixing them up and flipping them. And we used those big chunks of cash not only to survive and pay the bills, but we eventually used them to save more money. We reinvested those and made more profits. So I have a link in the companion article to a book. The book on flipping houses by my friend Jay Scott is probably the best place to start if you're interested in that business. The other strategy I'm going to talk about for those of you who find yourself in the growth stage are the more pure investment strategies of real estate investing. And these are something that I'm going to give you links to. And if you're reading the companion article or reference some other episodes that I've recorded on each of these plans, but you can also spend a lot of time on this in my book, Retire Early with Real Estate. So a lot of you maybe have read that book. If you haven't, recommend it. You can get it at biggerpockets.com/store, or you can find it on Amazon. But a big part of the goal of that book was giving you strategies on how to start from a smaller amount of money, grow that amount of money to a bigger amount, and then retire off of those properties. And so you can read about each one of these in my book as well. But let me list these for you. And then if you're interested in each one, you can go kind of check out more resources on it. One strategy is if you are kind of debt averse and don't want to use debt or don't need to use debt to buy real estate, you can use something called the all cash plan. And this is one of my recent episodes. If you go back and listen to episode number 54 called How to Invest in Real Estate Without Debt, the all cash plan, talks about a strategy and a case study for growing your wealth using just paying cash for properties. Obviously, it's going to depend on your market, depend on who you are, on whether that's going to work or not. Usually you have to buy a little bit lower priced properties to make that work. Another strategy that I really like is called the debt snowball plan, the rental debt snowball plan. And essentially this is where you borrow money on a smaller number of properties or bigger if you want to get a bigger portfolio. And then instead of using your cash flow from your properties and your cash flow from any other parts of your life to pay down all of those properties at one time, you concentrate and focus on one property at a time and you snowball it. So one property gets paid off, that frees up some cash flow from that property. Then you use all of that cash flow again to pay off the second one and the third one and the fourth one. So this is a way to first accumulate and grow a portfolio, and then you concentrate on getting them paid off. And now you have a free and clear portfolio that makes a great retirement portfolio where you can live off the income with very low risk. So you can check out the Debt Snowball. I did an episode on that on episode number 35. There's also a companion article you can find to read about it and kind of see the case study. Another one that I just did an episode on is called the Buy 3, Sell 2, Keep 1 plan. It's a way to use short-term rentals where you buy more than you need and then you sell off a couple of them and then you keep one. And it's a way to also get properties free and clear and to grow your wealth. And this works well in a couple different situations. Sometimes people find themselves in markets where they can buy a property below value, but it doesn't cash flow as well to be able to do the debt snowball plan. So you take advantage of that equity, that being able to buy low, and then you sell properties in order to generate equity to grow your wealth. So you can check out the episode I did, episode 55, on that strategy in the podcast. And there's also a companion article to check that out more. Another one that I wrote about in the book that I haven't done an episode about, but perhaps I will in the future, is using 1031 tax-free exchanges. And I call it the trade-up plan, where you basically start with a small amount of money, small number of properties. You sell properties. You don't pay any taxes on them using a special technique called the 1031 tax-free exchange, which you'll want to read about and understand a little bit more. But you can, by not paying any taxes, you can really compound your wealth quickly and build a larger portfolio. So you can check that out as well. The final strategy that I recommend at this stage for those of you in the growth stage is to use a self-directed retirement account. So if you have a lot of people don't realize that you can set up an IRA, an individual retirement account, or if you have your own business, you can set up a solo 401k. And instead of investing in the traditional investment options like bonds and stocks and things like that and index funds, you could actually invest in real estate, or my preference, make loans against real estate where other people are actively flipping or buying rental properties. So by doing that, you can often get higher returns. You can choose your investments. And so if you're somebody who wants a little bit more control, or you feel like you have enough availability of deals to be able to turn some of your retirement money into better investments using real estate, using a self-directed IRA is something that could be a possibility for you. I have done a little bit of both. I've done self-directed investing from the very beginning. When I first started my own Roth IRA, I started doing that. I also invest in index funds and a little bit more passive stuff. And I'm kind of moving more that direction over time, just because time has been more valuable for me than having to pay attention to real estate investments in my retirement account. So all of those are different options to focus on. Remember, the whole goal here is just how should you get started? You could pick one of those plans and say, all right, that's where I'm starting. That's what I'm going to try to do. You can always change later on, but my recommendation is to get focused and start somewhere. All right, so we finally arrived at my recommendations for people who find themselves in wealth stage number 5, which is income or withdrawal. You'll typically know you're in this situation where you need to turn some of your existing wealth, your equity, into something that produces more income with less hassle and less risk. And the prototypical person would be you already have a large enough net worth, you've kind of reached your financial independence number, and you're just ready to have early retirement. But this could also mean people who are at a plateau where maybe you've built enough wealth and you want to take a break and take a mini retirement. This kind of turn it off for a little while before you start growing again. This could also be you. So you'll exactly how much wealth you have at this stage depends on your situation. But the goal is to turn existing equity, wealth that you built, into something a little bit more passive, the income that you can live off of. So how do you do this? Well, there's a couple different ways. If you already have an existing real estate portfolio, my recommendation, or at least what I've done for myself, is to work on paying off some of your debt to increase your overall debt level, which in turn reduces your risk and increases the income that your existing portfolio produces. So exactly how much how much debt you should have is something that you're going to personally have to think about, what you're comfortable with. Some people want zero debt. I'm comfortable with holding some debt, but I like to reduce the amount that I have. My business partner and I do. But a goal might be anywhere from 0% to maybe like 33% or 40% of your portfolio. Meaning if you have a portfolio worth $1 million, don't have 70% loan to value. You're not having so many properties that you have 70%, that you have a lot of debt, higher level of debt. Why not pay off some of your properties and then maybe have a higher level of debt on the remaining properties? So maybe you have 70% on some properties, 0% on others, and the average might be 30 or 40%. That's kind of where I've landed for myself, kind of a best of both worlds in my case, where you can reduce your risk, increase your income, but still keep some of the benefits of having, low interest, long-term leverage. To do this, to accomplish that, what we have done is to sell some of our lower quality properties, or the ones that don't fit into our kind of overall strategy, and replace them, or to either pay them off and use that money to pay off debt. That's one way to do it. Another way you might do is just sell those low quality properties and replace them with better ones, like doing a 1031 exchange if you need to. So we've done a little bit of that where we just trade properties and trade up. We've done some where we just sell it, pay the tax, and pay off the debt on another property. Another thing you can do if you have an existing portfolio and you're in this final stage is to refinance any debts that are not optimal. So if you have some debts with balloons on them, adjustable interest rates, you might want to reduce that hassle and that risk by going refinancing and getting fixed low interest long-term debts. That's a way to sort of stabilize your portfolio at this point. If you have no existing portfolio, if you have some wealth in other assets and you're getting into real estate investing, you have a little bit different approach. You need to get more properties. But what I would recommend is that instead of starting with, to start with buying properties that are higher quality and typically nicer residential areas. This doesn't mean you get in like A properties, like the best kind of properties. You can go back and listen to one of my earlier podcast episodes on episode number 7, where to buy investment properties, the ABCD rating system. So I recommend buying more like B minus properties, maybe C plus, but don't get into the C minus, and definitely not the D type properties, because your goal here is less hassle and be able to live off your income, but also do other things. And so the lower you go on the ABCD scale, the more hassle, the more turnover you're going to have. And so buying higher quality residential properties, perhaps buying net lease commercial properties, or maybe even buying into limited partnerships with other people who actively manage the rentals. So all of those could be possibilities for you if you're just getting into the business. Another thing you could do if you're in this stage, instead of buying rentals yourself, you can make loans to other investors and then use your real estate kind of part of your assets to just be a lender. And you can do that inside your self-directed IRA, or you could do it just outside your self-directed IRA with your regular investment money. The final recommendation I have for those of you who are in this stage of being at stage number 5 is to diversify. And diversify could mean diversifying into other asset classes. So for me, I've had a lot of real estate. I'm very real estate heavy. So getting started or kind of making progress at this stage means getting into more index funds for me and to alternative investments other than just real estate. And it also means buying into other markets. I might have a lot of my properties in one market, and so trying to diversify into other markets. So definitely keep that in mind for you if you find yourself in this stage as well. All right. So I've just spent a bunch of time on just step number 2 of this episode. I promise some of the other ones will go a little bit faster, but it was such an important step because I wanted to give you a list of options. But here's the important part. At this stage, your goal is just to pick one, maybe 2, but pick one strategy that you've heard me list there and that you say, this is where I'm going to start. This is where I'm going to focus. And this might be difficult for some people because you want to know exactly if this is the right thing. But remember, you've just got to get started. You've got to choose something before you can go learn about it and do more and make progress with it. So as we get ready to move on to stage number 3, which is picking your target market, my request for you is to pause, to think about it, to write down, or if you're driving, just to think about it in your head, which one of those strategies is the place you'd like to start. And just pick it in your head, even if it's hypothetical. All right, I'm just for now going to pick this, buy and hold rentals where I'm doing the debt snowball. Like that was what you wanted to do. Just go ahead and pick it. It'll make the rest of these steps a lot easier to understand and to apply to your situation. So pick that strategy, and then we're going to move on. All right, so step number 3 of the 9 steps to get started in real estate investing is to pick a target market. So you have some sort of strategy, right, from the prior step. Now you've got to pick where you're going to apply that strategy geographically. With prices so high in a lot of locations around the country, particularly on the coast and in big cities, people ask me a lot whether they should invest close to home or whether they should choose a new market. It's a good question because the market you choose can make a big difference in your final results. My preference and my recommendation is always to invest as closer to home if possible. Not necessary, but if possible. I think there's some built-in advantages to getting started in your home market. Being local gives you the advantage of being kind of an intimate, kind of intuitive knowledge of that market. If you go to a new market, you're going to have to learn a lot about it. You're not going to have the advantage of somebody living there does with all the local neighborhoods and where it's good, where it's not. And while managing real estate from a distance can be done, when you're first starting, it's still more efficient and effective to be local as you're learning the business. If you're a professional and you got all your systems set up, being long distance can still work as well. I would personally start evaluating your market close to home first, if possible. If prices seem too high in your local neighborhoods, explore a few ideas like outside of your kind of core market first before you go really long distance. For example, you might want to drive 1 hour away. I've got a friend who is in New York City, lives in Manhattan. He drove an hour away and bought properties that did make sense for him. So that's possible even in big cities like New York City. Often the suburbs of those major urban areas are more affordable. That's where people move to find more affordable housing. They still have jobs. And so those might make for more reasonable investments where you could still be there and kind of get started close to home. The second thing you could do is to look for smaller niches within your overall market. So within high price markets, you could find niches like condos, perhaps. Sometimes you can find mobile homes, not always in big cities, but maybe in higher price places like California. You might be able to look for niches like tax liens, note investing, something like that. So there's different niches other than just buying a standard rental property, a single family house or something might still work in higher price markets. I haven't done a podcast episode on it yet, but I have done a long article on how to pick your niches, like different niches. And so you can look at the companion article and find a link to that. But whether you stay close to home or whether you invest somewhere else, there are still some kind of fundamentals that you want to follow for evaluating your market analysis in the first place. If you go back and listen to episode number 41 of this podcast, the whole episode is about how to pick the ideal market or the ideal location for your investment properties. And that'll give you an idea of the type approach that I use when I'm evaluating the market. And just a brief summary of what you'll find in that episode is that you're looking at big picture criteria like jobs and economics, like population growth, like your price to rent ratios. Those are some important criteria kind of from a regional standpoint to pick the right region to invest in. And then just as importantly, once you get a region that you like, you look for small scale location criteria. So you want to find the little pocket neighborhoods and the little school districts or, wherever within your market, little sections of your market that are convenient, that have walkability perhaps, that the safety and crime rates are a little bit lower, that have public transit if you're in an urban area or school districts if you're in a suburban area. There's certain things like that are important. And so all of those kind of criteria, both on a big level and a micro level, kind of come together to create good investing or what I call like fertile soil to actually go out and invest your money. So definitely keep that in mind. You don't have to get too caught up in that. That's another one where you could really get into analysis paralysis. I would go back to start with what I talked about in the beginning. Try to start local. Try to find areas where the price to rent ratios, maybe where you can get close to finding properties that make sense from a rental standpoint. And then start looking at some of those micro criteria, small scale location criteria to find the best locations within your market. And like choosing a strategy, I recommend just picking something. It doesn't have to be perfect. Even if you bought one property in a certain market and it wasn't perfect, you realize you made a mistake later on, that's part of entrepreneurship. You can pivot, you can change. It wouldn't be perfect. You wouldn't want that to happen, but just make a decision. And at least for this exercise in this episode, choose what you think the market where you're going to invest in for now. And then you can go back and adjust if needed. So but to proceed to the next step, pick a market, keep something in mind, press pause, and just think in your own head or write down what you think that market will be where you're going to invest. And then we're going to move to step number 4, which is deciding your investment property criteria. Your investment property criteria basically tell you, and they tell other people who are on your team, what it means to have a good investment. I actually recommend creating a written investment profile. I call that a target property profile that you can share that with any of your potential partners, your money partners. You can share it with other investors, and you can share it with people who are going to bring you leads for properties like your real estate agent. Your written investment profile that you'll create should include descriptions of two major categories. Number one, it should list your target property, so the type of property you're looking for. Number two, it should list the target terms, so also known as the numbers. So what kind of property do you want, and what kind of numbers make that property a good deal? Your target property is going to become clearer and clearer when you choose a market, like we talked about in the prior step, but also when you decide, if you do happen to decide a niche within that overall market. Now, finding a niche means that you focus on one smaller segment of the entire market. So if you looked at all of the residential real estate in Atlanta, for example, Atlanta, Georgia, that is an enormous amount of real estate. You could even narrow it down to all of the residential real estate in Coweta County, which is where I grew up, is in Metro Atlanta. Even that is a huge market. So getting a niche means is you slice it down into even smaller steps. And it could mean all of the single family houses in a certain price range. It could mean mobile homes in a certain price range. It could mean a certain school district. And I actually have an article you can find linked in the companion article here called the 35 Best Niches for Investing in Real Estate and How to Choose Yours. So this is not a necessary step to get a niche, but it's a very helpful step. And so you could go and figure out which niches might make sense for you to try out by reading that article. When you've chosen a niche, or maybe a niche or two, your basic target property description may look something like, when you write it down, will sound something like this. For example, it might say single family houses with 3 bedrooms and 2 baths in the 30263, 30265, and 30267 zip codes. The target full market price range is between $120,000 to $199,000, and the ideal properties are on quiet, safe streets, convenient to schools and shopping. Ideal properties also include a garage or storage or a usable yard. So that's a very specific example of what a target property profile will look. That's describing the type of property, the price range, the zip code, and that's what you want to get. You want to get, if you're getting a niche, that you get really specific, and that makes your search for properties a lot easier. And I would always rather start with a smaller niche all the way down to like just a neighborhood, for example, and then get bigger once you've exhausted your search within that neighborhood. If you want to read that description again and kind of see how that works, definitely go check it out in the companion article, which you can find in the show description. But remember, target property is one thing. Target numbers or terms is the second category of how you narrow down this step. And so I also wrote a comprehensive guide on the numbers. It's called How to Run the Numbers for Rental Properties, back of the envelope analysis. So for now, I'm actually going to create an episode coming up not too long in the next month or two on that exact topic. So you can stay tuned for the listening to the podcast episode. But in the companion article, I have a link to that article where I go step by step through the different criteria of how to run the numbers. Your ideal terms, so what the numbers are that are good for you, are going to depend on the choices you made up to this point. So the price range, the market, the niche, everything else. But let me read you an example of what your description of the target terms might sound like. It might sound like this. Target purchase price, including upfront repairs, should at least meet the 1% rule. And if you don't know what that means, I did an episode on the 1% rule, episode number 4. It's kind of a basic way of running the numbers early on in your analysis of a property. So go check that episode number 4 out if you want to listen more about that. So back to my description though. So it should at least meet the 1% rule. Net rental income after financing for multi-units should be at least $100 per month per unit. And for a single family house should at least be $200 per month total. Cash on cash return should be at least 10%. And the discount from full value of the property should be at least 10%. So all of those are some of the terms you'll learn when you read that article, How to Run the Numbers for Rental Properties. You could get as complicated as that, having 3 or 4 different terms, or you could just say, I want it to meet the 1% rule. I also want to make a certain amount of cash flow per month, $100 per month, $200 per month. That would be reasonable. That would be at least having a financial goal to work off of. And also know that your criteria for your numbers may change over time. I know mine have. By choosing some kind of a basic investment property criteria, this again helps you with the goal of this whole episode which is getting started. It gives you something to work off of, makes you more confident, and it gets you kind of laser beam focused on a certain thing that you're hunting for. And so once you do that, you have this focus of what your target property, investment property criteria are. We can move to the next step, step number 5, which is to build your team. As many of you know, real estate is a team sport. And you, as the entrepreneur, the owner of your real estate business, even if it's a tiny little business, you're the leader of your team. You don't necessarily need to have official employees who work for you and are on payroll, something like that. As a small real estate investment business, it's very likely you will have independent contractors, like people who do repair work for you, or advisors, people like a CPA, an attorney. So all of those people are going to be on your team, and you're still the leader of that team, and you're the one who has to leverage their expertise. If the idea of running a team actually turns you off, which I know for some of you it will, then perhaps a different type of investing suits you better. Real estate, this is what it's about. People are involved in real estate. You don't necessarily have to be like an extrovert and going out and talking to everybody, but you do have to be somebody who knows how to leverage the skills of others, or at least need to learn how to do that. I wrote more about my own approach to building a team and the things I'm looking for in an article called Your Team, the Main Ingredients of Stardom. And you can find that link in the companion article. But to summarize it here, I want to give you a list of some of the important team members that you're going to need. And I actually picked up these categories from a really good real estate book that's in my top 10 recommended real estate investing books called The Millionaire Real Estate Investor. So if these categories sound familiar, that is where I got them from. The first category of team members you're going to need to have is your inner circle. So the inside, your core people. These are your closest team members. This is people who are close to you personally, like your spouse if you have one, or a partner. It could be a business partner, and it could also be mentors or personal advisors. So these are just people who you trust, who you go to for advice, who are kind of going along on this ride with you, perhaps in the case of a spouse or a family member. And so your inner circle is super important. And you got to prioritize them in your real estate investing. I do get people who email me sometimes and saying, hey, how can I get my spouse on board? How can I convince them that this is a good idea to invest in real estate? I don't have a lot of good answers for that. I don't know that I had a how-to on figuring that one out. But all I do know is that is one of the most important steps, that you have to have that discussion, that if your inner circle isn't on the same page, and if you're not getting advice from them and listening to them, then it's going to make it hard to do everything else. So I would focus and start there. But as you move out from that inner circle, you're going to have what's called your support circle. And these are what are called fiduciary or critical relationships, people who are obligated to help you either legally or just ethically. Their job is to help and think about your best interest. And so these are outside people that you hire, but they have that important fiduciary kind of criteria. And they help you with a lot of your important ongoing decisions and tasks. So the people I'm thinking about in this support circle typically are people like your property manager. If you're a rental property person and you're hiring people to do it for you, a property manager is one of your most important support circle key members. An attorney who specializes in real estate or business is another kind of person in your support circle. I also have a certified public accountant or a CPA who I work really closely with. They're somebody who helps me prepare my taxes, but they're also, because they help me prepare my taxes, they know my business. They're with me for the long run. And he in my case, helps me make some of the key decisions. Like when we're selling a property, when we're making a change in our business, we always talk with our CPA about it. Some other people that you might find in your support circle could be your lenders. Now, lenders could be in the service circle that I'm going to talk about next, but I find them really important because they're going to be people who you use over and over and over again. They're not necessarily fiduciaries for you because they're, lending their own money and have their own interests there as well. But you might find that your mortgage lender, the person who helps you get long-term financing, or a private money lender who's a person who continues to loan money to you, or maybe even a hard money lender, those people can almost become advisors and helpful in your business too. I think in particular, my private money lender, the 2 or 3 that I've used for a long time, have become mentors, have become friends, and are really important parts of my business who I ask for business advice as well. And we have sort of a symbiotic relationship where I'm helping them, paying interest to them and providing them good returns over time. And they're providing an outside set of eyes who has a financial interest in my business. And so I find that to be very helpful to have them in my support circle. So as you keep going out, you're going to build team members in what's called a service circle. And these are your functional relationships. And these are important people too, who do a lot of the normal day-to-day tasks in your investment business. These are going to be people like your closing agent or title company, people who handle your closings for you. These could be a home inspector, all your contractors like electricians, plumbers, heating and air technicians, handyman, painters, yard service people, pest and moisture control people. That's really important around me to have people who can help me out when we have moisture issues in a crawl space or something and help me solve that. And then for bigger projects, a general contractor. So all of those are people who you might not need to have today. And if you have a person like a property manager, or I didn't mention a real estate agent in the support circle is somebody who will be also very important to you. But those kinds of support circle people might help you figure out and build out your list of service circle people as well. How do you find these people? That's something people ask me a lot. How do you build these team members? And my number one recommendation is by networking and going to places where other real estate investors are meeting. And for me, that's been my local real estate investor association. I'm in the Greenville, upstate South Carolina area. So I've been a member of upstate CREA for a long time, since the very beginning of my investment career. And typically you can find other real estate investing associations in your town or in your city. You can also, because this is the age of the internet, right? And I'm a big fan of Bigger Pockets. They published my book, and I think they're an awesome resource online. And they have a local meetup part of their Bigger Pockets network, where you can connect with other people and have a forum with other people in your area. And there's always meetups going on with Bigger Pockets as well. So either one of those, you start there and you go with a list of potential people on your team, and you start asking questions and finding out who other people use for an attorney, who other people use for a property manager, who other people use for electricians and plumbers. And your goal is then to build out a list of reliable people who have been references from other investors and people in your area. All right, so that I could say a lot more about building your team. It's a really important step, but let's move on to step number 6, which is lining up your financing. Unlike other forms of investing, so investing in the stock market or something, it's actually fairly normal in real estate to use financing or debt to help you with your real estate purchase. And there are many options to choose from, but I'm going to try to give you a list here of some of the more common ones and just give you a brief explanation of each one. And your goal with this step would be to choose which one of these, or maybe two of these, that would be the ones that you want to focus on and learn more about and start with. So the first one is something called FHA, or Federal Housing Administration loans. These are a type of loan that are insured by the federal government, and they're typically easier to qualify for than most other loan programs. The terms for an FHA loan typically include a smaller down payment. So I think at the time I'm recording this, it's about 3.5% down. So if it's a $100,000 property, you'd need to put $3,500 down. It also has a fixed interest rate, and it's a long-term loan. So it's a 30-year type fixed financing, which is important when you're buying some of your early rental properties. There's some downsides of those as well. They typically have a little bit higher fees, and there's an ongoing what's called a mortgage insurance fee that you're paying to the federal government for insuring this loan. But for some of you who are just getting started and getting your first deal, getting that loan, just getting it done, even if it's a little bit higher cost, could be a big deal because it's a smaller down payment. So FHA is a good place to start. Another similar loan to FHA is called a VA loan, or Veterans Administration loan. You must be a veteran to qualify. That's the name, Veterans Administration. But if you can qualify, it's one of the best loans available. It includes a 0% down payment. So you could put money down if you want to, but if you're tight in your first deal and you just want to use more leverage, you can get 0% down. It also has, like the FHA, has a fixed interest rate and has a long term. So it can be a 30-year loan. So if you're a veteran, or not only a veteran of Army, Navy, Marines, and Air Force, but I think it also includes the Coast Guard and some of the other, you need to check the qualifications. If you've been in any of those services, I think those apply. Another type of loan that many people start with is something called a conforming loan. Conforming just means that it conforms to the guidelines of the mortgage giants who actually either service or buy a lot of the loans out there, the mortgage loans. Fannie Mae and Freddie Mac, those are two big quasi-government entities that kind of influence a lot of the mortgage market. If they conform to their standards, they're called conforming loans, which means they typically have a little bit better terms, a little bit better rates. The terms often include about 5% to 20% down. If you have a 5% down payment, you'll have to pay something called mortgage insurance, which increases your payment a little bit. But again, if it gets you in on your first deal or two, Sometimes that can make sense, but more typical would be to put 20% down on a conforming loan. Like FHA and VA, you'll have a fixed interest rate and you have a long-term loan. Now, something I didn't talk about was the difference between an owner-occupied loan and a non-owner-occupied loan. For both the FHA and the VA loan programs, you're going, at least to in the beginning, need to be an owner-occupant, meaning you buy the property, you move into it in order to get that loan. And you can later on, if you, a year or two from now, decide to move out and buy another property, you can rent the property out and keep that loan later on, but it definitely needs to be your residence. With a conforming loan, you have the flexibility of either being your residence or being a pure investment property that you never move into. The interest rates and the terms might be a little higher. The interest rate might be higher and the terms might be a little bit more strict if it's a pure investment property as opposed to an owner-occupied property. So you might be able to get in with lower down payment on the investment side of conforming loans. But there is some flexibility there between owner-occupied and non-owner-occupied where you don't have that with FHA and VA. All right, so moving on to some other options. Those are kind of your standard 30-year fixed kind of loans that you think about when you're buying investment properties. But you also have some other possibilities that other commercial real estate investors also tend to look at. One is something called a portfolio loan. Now, this is a big umbrella of loans. And it just means a portfolio means that the bank or the lending institution who makes that loan, instead of selling it off like a lot of banks do in the mortgage market, they actually keep that loan on their portfolio or on their books. The terms vary a lot depending on the bank that you're using or the lending institution you're using. But these are often like your local banks or your regional banks who have a commercial lending department. And the typical terms, if you had to go there and just kind of understand what's normal, is you might have a 5 to 10 year loan as opposed to a 30-year loan like you could have with some of the conforming typical mortgages. And with a 5 to 10 year loan, meaning it might still have a amortization and it has a payment as if it's paying off over 20 years or 30 years, and it might have a competitive interest rate as well. But whatever you owe 5 to 10 years from now, you'd have what's called a balloon, and you got to pay it the entire amount off at once, or you have to refinance it at that point. That's a pretty common term with portfolio loans. Hard money loans are another option that you might look at. I've actually personally never used a hard money loan, but I've used something similar to that called a private loan. And both hard money loans and private loans typically come from individuals who have wealth and they're trying to decide to loan their money to other investors. Hard money loans are typically it's more of a company or an organization that's making those loans for multiple private lenders. And private lenders are more just individuals that you happen to meet, maybe at a real estate investing club, maybe at another meetup. And this person agrees to loan you their money. Maybe their self-directed IRA money that we talked about earlier, and they might loan it to you in order to buy your rental property. Typically, the interest rates are higher for both hard money loans and private loans. It's often a shorter term loan. You just need to buy it and then get it fixed up and get it rented out and do like a BRRRR deal, BRRRR, buy, remodel, rent, refinance, repeat. You might hear that a lot on Bigger Pockets. And so it's a good short-term loan, but it's often not a good long-term loan. So you might need to refinance with a conforming loan or a portfolio loan or something else after using hard money or private money. The final loan I'll talk about, which is not as typical, but it's something that's been really important for me and a big part of my business, is something called seller financing. And this is probably my favorite type of financing when I can get it. And this basically means a seller, somebody who has equity in the property, meaning there's a big difference between what the property's worth or they sell it to you for and what they owe on it. And hopefully they owe almost nothing on it typically in those cases. But if they do, they have that equity, they can allow you to pay the purchase price over time with interest. And so instead of you going out to the bank and getting a loan, you could make payments to the seller. Maybe you make a down payment to them and then they finance the balance. There's a lot that goes into seller financing and negotiating it. I'm actually going to do a podcast episode on it in the future, but you can look at the companion article and have a link to a very detailed article that I wrote on how to use seller financing to buy real estate. The type of financing you choose is going to depend a lot on the prior steps that we went through. It's going to depend on your financial situation, number one. It's going to depend on your particular strategy that we talked about in step number two. And it also depends on your personal preference. you want to rely heavily on your mentors and your team members that we talked about in the last step number 5, to make sure you find some financing that best fits your situation. But once you have a solid plan for financing, we can then proceed to step number 7, which is to raise cash for your down payments and your reserves. Like I talked about in the prior step, real estate investing is a type of a business and a type of investment that allows you to use other people's money, the bank or maybe a private lender, in order to help you move forward. But you shouldn't count on building your entire real estate investing business with no money down. Even when you use the highest leverage scenarios, like the 0% down VA loans that I just talked about, you still are going to have to save cash for reserves. So to set some money aside in case something happens. So how much money, how much cash will you need? And how do you raise it once you know how much you need to get? Well, the amount of cash that you need is going to depend on your strategy. It's going to depend on the pricing in the market that you're going after. So whatever your target market is. And it's also going to depend on your property criteria that we talked about in step number 4. So the numbers that you're looking for. But you can also ask your lending team. So the step number 5 that we talked about, building your team members, you can ask them how much of a down payment you're going to need for the particular loan program that you're looking at. So if you're doing FHA, that might be at a 3.5% down. If you're doing VA, it might be 0% down. If you're doing a conforming loan and making 20% down, that might be what you need. So that my point is this is why it's kind of chronological with these steps. You need to know at the prior step, and you need to know have some team members built together in order to figure out how much cash you need. For example, let's say that your financial priority is in that your wealth stage is increasing your savings rate. So you're in wealth stage number 3. You then decide to use the house hacking strategy to purchase a duplex for $150,000. You may be able to find an FHA loan with a 3.5% down payment. That's the financing strategy that you chose. So you'll need, in that case, $5,250. Actually, I just rounded it off. That's 3% of $150,000. So $5,250 for your down payment. And perhaps you need another $3,000 for closing costs. But you may also need cash for property improvements and reserves for a rainy day once you buy that property. So let's say you need another $10,000 for that. So this is one of the lowest down payment scenarios you could come across, FHA loan with a small amount of repairs, and yet you would still need a total of $18,250. That's $5,250 plus $3,000 in closing costs plus $10,000 in reserves and some repair money. So how do you find that money? So you need almost $20,000 even in a pretty low down payment scenario. So where are you going to get that? I'm going to give you a few ideas here, but you're the one who's going to have to kind of work on these and go out and do them. The first recommendation is just to save money. I know that sounds really obvious, but sometimes you just need to make the investing and the saving of money for investments a priority. Maybe you need to work for some extra income for a little while. Maybe you need to cut some of your other expenses out of your life that are not as important as real estate investing. And maybe you just need to be patient until you have the money saved. It might be okay waiting for 9 months to get started until you have enough money saved up. Maybe you do, the side stuff that I talked about earlier where you get into real estate investing on the side. Or maybe if you have a really good job and you just keep focused on making more money at your current job. There's no shortcuts here to saving money, but that's always got to be an important part of it. Another thing you could think about to raise some of this cash is selling stuff. Maybe could you sell a car that you have right now that's an expensive car, and could you buy a less expensive one? That's not a pleasant idea for some of you, but is real estate investing more important than the car? Which one would you rather have? The fun car or the status symbol car, or having a property that could eventually help you achieve financial independence? You got to make that decision. Or maybe you have other expensive toys that you can sell and then get them later in life. I'm not saying you need to not have toys and not have your boat or not have a fun motorcycle or something. But if you can sell some of those things for now and invest, you can have options to get more of those later on in life. If you're really serious about this, you might even consider selling a big home that you live in right now that has a lot of equity built up and is not getting used right now, and then downsizing your home or maybe even renting. One of my mentors and people I've learned a lot from in real estate investing, a guy named John Schaub, who wrote a book called Building Wealth One House at a Time. In his first 10 or 15 years of his investing business, he was in his 20s when he started, he rented a house the entire time. So he was buying investment properties, flipping them, buying rental properties, but he rented his own house. So that could be a good scenario for you as well. Sell your home that has a lot of equity in it downsize, or rent. So those are just some ideas, selling stuff, selling toys, selling your house, selling your car. Sometimes you have a lot of untapped equity that you just need to sell stuff and get some of that cash to do your first deal. You could also think about borrowing. This is one you need to be careful with when you're talking about borrowing money for an investment, because you're already borrowing money to buy the property. So if you start borrowing down payments as well, you're using a lot of leverage. I'm personally comfortable borrowing some of the long-term loans, like the 30-year fixed kind of money, but personal loans, credit cards, lines of credit for down payments, those are a little bit more dangerous, especially if things go badly. The problem with doing that is the discipline of cash flow. If you borrow $10,000 for your down payment, you have to know that the investment you're going to put that $10,000 in will pay you enough to pay the interest on that $10,000. And in many cases, it doesn't. If that doesn't happen, you're going to have to come out of pocket to pay that interest. So that is you're not moving forward when you're having negative cash flow like that from the very beginning. So is it always something bad to do? Not always. If you have a really good investment, it's really early on, and maybe you have a plan to pay off that down payment really quickly, you have a bonus coming or you have some other money coming, then maybe it makes sense to borrow for the down payment. But you just want to be really careful doing that. I'd rather sell and I'd rather save if all things being equal. A final way to raise the down payment is by using a partner. So partnering, I kind of look at partnering like sharing a delicious cake. I like eating cake. I like desserts. So what if someone offered me a rich chocolate cake, which is one of my favorites, and they offered it for 50% off the price. But what if I didn't have the money to buy that chocolate cake? Wouldn't it make sense to go find another friend of mine who loves chocolate cake too? And they know that a cake normally costs $10. And I say, hey, I got this chocolate cake. And what if you put up the money? I'll split it with you and we'll both have some cake. So they found a cake that they get to eat. I get a cake that we could eat. And I'm the one who found the deal at 50% off. So we both win. Maybe that analogy is not perfect, but in real estate, that is the way partnering works in a nutshell, is that it's worked very well for me going out and finding really good real estate deals. But if I didn't have the money, I would never be able to buy that deal. So by getting a partner who puts up the cash down payment, maybe they put up the credit as well, we're able to buy that deal that I wouldn't have bought otherwise. So the key, partnering is not always easy. It has a lot of pitfalls as well. One of the most important things I've found is communicating clearly upfront and in writing with your partner to make sure your expectations and your goals are very clear. So that's a topic, as I'm saying that out loud, I think it's one I want to do some future episodes on. So be on the lookout for that, about how to partner successfully in real estate. So all four of those, saving money, selling stuff, maybe borrowing, and partnering, are different ways you could raise the cash for your down payment. So now that we've talked about financing and we've talked about your cash, let's move on to step number 8, which is creating a plan to find your deals. The first thing I'll say about finding deals is that good deals, good real estate deals, don't just land in your lap. They don't just happen and kind of come out of the sky and all of a sudden they fall on you. Finding good deals is a lot more like a treasure hunt. You have to go out and work at it, and you have to turn over dozens and dozens of stones or rocks or dig in the ground before you find a hidden gem that's called a real estate deal. In periods like 2008 to 2011, during the Great Recession, those are kind of the exception to that rule. The treasure hunt for real estate deals was much, much easier during that time period. And it's kind of funny that when I listen to other blogs and the people who've gotten into real estate investing, a lot of the louder voices were people who got started in 2008 to 2011, and they're basing a lot of their kind of approach on that. Well, Warren Buffett said in his 2016 letter to Berkshire Hathaway shareholders, he described that period very nicely. He said, every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. So the point he made was those periods come sometimes, and we need to be ready for them, and we need to go buy the best deals we can at that point. But the point I'm going to make here is that we have those ready. We get ready for the times that it rains gold, but the rest of the time, it's not like that. It's a lot harder. During normal economic times, you have to work hard and create a plan to bring those good deals to you. It's more competitive. And you have to stay disciplined with your investment criteria that we made back in step number 4. You can't just, because everybody's so competitive, change your criteria and buy bad investments. just because everybody else is doing it. So you have to not succumb to the fever of a hot market. And as some of you know, I actually have a course. So I'm going to tell you a few ideas on generating leads right now in this episode. But also, if you really want to go in depth, this is a really important skill. I have a course on this called Real Estate Deal Finder, where I share 17 methods that I've used over the years, and I share a case study of how I bought 33 deals in 1 year using a lot of these strategies. So if you're interested in that course, you can go to coachcarson.com/deal finder. If you go to that link, you'll actually get a 30% off for being a podcast listener, 30% off the price of the course. So that is definitely a good place to start, is learning how to find deals. It's not a necessary thing. If you have a way to find a deal or two here or there, you can wait and buy that later on, but definitely want to recommend that as a way to kind of supercharge your ability to find deals. All right, so back to kind of summarizing, though, how to find deals. My recommended plan for doing that kind of comes in 2 steps. Number 1, you need to create a budget for marketing. So a budget to actually find good deals. And number 2, you need to create some marketing campaigns to bring those deals to you. So let's talk about the marketing budget first. If you have a $0 budget for marketing, you're just going to have to get creative and plan to spend more personal time instead. You either have to spend money or time, one of the two. If you don't have the money, it's more challenging to do it, but it's not impossible. That's actually the way I got started. It was just hustling and going out looking for deals. So you can do it as well. If you have a little bit at a kind of a higher level, if you have about $500 per month, so $6,000 per year that you're willing to spend on some marketing, you probably have enough to create a very workable marketing campaign or campaigns to start buying some more deals. If you are even higher level than that, you have like $1,000 per month or more, you can really set yourself apart from the market if you're smart with your lead generation and your marketing. So investments in marketing for me have always been one of my best investments I've ever made within real estate investing, even better returns than buying properties. You don't want to spend a ton of money early on. I would rather you actually start with some of the zero budget options that I'm going to talk about here in a second. But just know that once you do start spending some money, that might be something that separates you from everybody else. So let's talk about what you would actually spend that marketing money on, which are called marketing campaigns. And I sort of think about this like fishing. So if you're going fishing, you want to put a lot of fishing lines in the water. If you were going to try to catch as many fish as you could to eat fish, for example, you wouldn't just put one fishing line in the water. You put a lot of fishing lines. And so there are many possible marketing campaigns or fishing lines that you could use. And marketing in general is kind of an inexact science. I can't just tell you this is always going to work and then you can go out and do it. I can give you ideas and best practices, but you have to go out and test it, just like a scientist. And in camp, you have to adapt them and change them with the way the market changes. All of these are ideas, but I recommend you kind of test them and go out there and do them. So here's some of my favorites. I'm going to start with some free and low cost methods of finding deals, and then I'll get into some that cost a little bit more money. The first one is setting up an MLS campaign or a multiple listing service. What you would do here is either if you're an agent yourself, if you become a real estate agent who has access to the MLS, or you could hire a buyer's agent to be on your team, which is more kind of the approach that I take. You would use them to leverage this database called the multiple listing service where most of the properties for sale are listed. So the agent that you have, or if you do it yourself, you can set up automatic emails that'll come to your email inbox every single day. You could do it for all the new listings. Every time a new listing in your market comes up, you could do it every time a property's price is reduced, or you could do it. There's some other kind of criteria you could use as well. The warning I would give you about MLS is that there are a lot of properties out there, but anytime there's a real deal, most of them are not deals for you as an investor. And when there is a deal, you have to move very fast. And I'm talking about like minutes, not hours and not days. So you've got to be ready to jump on a deal if you see it, because everyone else is doing this campaign too. Lots and lots of people out there doing it. So if you do the MLS, I bought a lot of properties on the MLS. One of the first flip properties that I bought was off the MLS, and we bought them over the years kind of periodically. So definitely do that because it's a free way to buy your property. Your agent will make their money on the commission when you buy it, not up front when you're having to pay for marketing. So another way to do it, so MLS is one I would start with. Another way is to do referral and networking. So just telling everyone you know that you're looking for properties. And remember how early on we talked about what your property criteria are? That was one reason you created that target property profile, was to share that with all of your friends, your family, with your professional contacts like your CPA or financial advisor, with attorneys, with your real estate agent, with property managers, anybody who might come across a property that could make sense for you. You want them to know what you're looking for. So you can do that. You can tell your whole world about it. You can also attend networking meetings like at landlord associations, real estate investing associations, and other real estate related meetups. And you just want to tell people what you're up to. Have a flyer printed out, have a business card, hand it to them, tell them what you're looking for. That's a way. It's become, I think, when I last looked at it, at least a third of the deals I currently get and a third of the deals when I'm really ramping the volume up have always been from referrals. So I work very hard on doing that because you're getting deals that nobody else knows about often. And that's important. Another campaign I like for kind of the free or low cost area is driving or walking for dollars. This basically means you regularly walk or drive your target neighborhood and you look for things like for sale by owner signs and you call those. You look for rent by owner signs. You call those as well because a person who's renting a property might consider selling it. So you can just talk to them about that. Some of the gems you find along when you're doing walking or driving for dollars is looking for vacant or rundown properties and you're typically looking for ones that aren't listed. They don't have a sign in front of them, but sometimes you might even look for the vacant rundown properties that do have a sign in front of them and you call the realtor. The point is you're going to be out in the neighborhoods you're looking for all these properties. And then you become a detective and you start calling, asking questions, talking to neighbors if you can't figure out who owns the property and asking them for help. Say, hey, I'm looking to buy a property. I saw this one looks vacant. Do you know who owns it? I'd love to talk to them about buying it. That's what you would do while you're out in the market. So a lot of that is just, like I said earlier, being a detective and following up. Maybe you send letters to those people. Maybe you call them. But the point is you're going out in the market and finding these little gems that a lot of people don't know about. There are some other methods you could use as well, low cost ways. And this episode's already gotten long enough, so I'm going to let you go look at the companion article to find a few more ideas for the free or low cost ways. But let's talk briefly. If you do have a little bit more money, some of the more typical ways to spend money and to find more leads is something called direct mail. And so there's a lot of different lists out there. I'm going to do other episodes in the future on this. And my course that I talked about earlier goes into much more depth on how to do these. But you could send letters to people who are non-owner occupied property owners, meaning their mailing address is not at the property itself. So these might be landlords, they might be people who inherited properties. And so you can build lists like that, like multi-unit property owners, like eviction landlords, expired listings, delinquent tax owners, estates and probates, or pre-foreclosure. Those are all some of the common lists that people start mailing to. And you can start working on paying for letters to go out to these people and then asking them to call you back. It's kind of a science to that. And if you get it wrong, you could spend thousands of dollars and get nothing out of it. So that's why it's a little bit more advanced strategy. But I've bought a lot of properties over the years from direct mail. So something I recommend you learn about as you're getting ready, probably to take it to the next level. On your first deal, maybe that's not the approach to take. You could also spend money on signs, like putting signs on your car. You could spend money on a website and social media. You could buy advertising on Google AdWords and Facebook. That's kind of a newer, effective way to do it. But again, all of these are something you want to think about in the back of your head as you're getting ready to sort of ramp your business up even more and buy even more properties. But on your first deal, I really like those free, low-cost ways of finding deals to start off. So the main thing you need to do right now is to decide on a budget. Hey, do you have $0? Do you have $500? What can you spend? And then choose a campaign or two that you're going to focus on. And obviously there's more to learn, but if you choose one or two and say, I'm going to go learn about those, I'm going to study them, then that'll help you to do the goal of this entire episode, which is to get started. All right. So let's wrap all of this up by going to step number 9, which is the final step, and is to schedule your time and prioritize your next actions. So this has been a long episode already, and I hope it's been helpful for you. I hope it's been practical. But I've given you a lot of information so far. I've told you a lot of different things. And so at this point, I want to wrap it back up by helping with the original promise, which is how are we going to use this information you've been listening to actually get started? So that the point of this step number 9, is to help you transfer all of that information in your head, maybe the information you had before you even listened to this, and get it organized and effective and take action on it right away. So the first, I'm going to make a recommendation about scheduling your time. After that, I'm going to talk to you about prioritizing your actions within that schedule. So for scheduling your time, you know how your life is. All of us are busy, but you know how your typical weekly and daily schedule goes. But I assume, like most people, you get into a day and you get really busy and you get caught up with things. And so here's an important question that I want to ask you. How much time can you or if you have a partner or a business partner or a spouse who's going to be working with you, how much time do you or your partners have to carve out each week to dedicate to your real estate investing business? So within your existing schedule, how much time can you carve out realistically? And while I do want you to be realistic and say, hey, I'm busy, I don't have that much time. On the other hand, I also want you to think about how important is real estate investing to you. If it's something you really want to get started on and it's a high priority for you, you're going to have to be ruthless with your priorities. You're going to have to cut out some stuff that maybe doesn't make the cut. It's not as important as real estate investing. Also keep in mind that when it comes to time, that things go in waves. They go up and down. And so real estate investing is something that you have to put a lot of energy into up front, but it's not a forever project. This isn't something you're always going to have to spend this much time on. You're going to spend a lot of time in the first few months to a year, but later as you gain momentum, as you buy a property, as you buy more than one property and you build systems and kind of get a team set up, it's going to become a lot easier. You have a lot more leverage over your time. So how much time do you need to carve out specifically? You need at least 10 hours per week in order to give yourself a minimal chance of success. So 10 hours a week. If you can do more than 10 hours, you're going to give yourself a lot better chance of success. If you can do something like 20 hours a week or 30 hours a week, and this can be you personally, or this can be collectively between you and other people who you're working with, like your spouse or a business partner. If you can do that, the more time you can spend early on, the more you're going to increase your chances of doing well. So what I would recommend is for you to look at your calendar. If you're driving your car, obviously you're not going to do that right now. But if you have the availability and you have a calendar either on Google or on a paper calendar like I use, pull it out, look at it, and specifically block out times this week that you're going to work on real estate. Sometimes early in the morning, sometimes late at night will be the easiest way, sometimes in the weekend. Before things get rolling in the morning is often a really good time to do it when it's quiet, and carve out that time and add it up every week to try to get to that 10 hours or maybe 20 hours a week and to see if that's possible. And if it's not possible, at least maybe this is not the right time for you to get started. Maybe you're still in learning stage and that's fine. But if you don't beat yourself up about it until you can look at it and say, I really do have some time. I'm going to commit to it. I'm going to prioritize it. I'm going to do it. And then put it in your calendar just like you would a doctor's appointment. You wouldn't miss a doctor's appointment if they are going to charge you for it or if you're going to have to do it. And so you shouldn't miss an appointment with yourself that you make ahead of time for your real estate investing. So that's my recommendation number one, is to block out some time to work on whatever you need to work on from all the things we've talked about in today's episode. My next step is to prioritize your next actions that you're going to do within that block of time. There's an awesome book that I read called Getting Things Done by David Allen. I read it pretty early in my real estate career. I'm really glad I did. And one of the main ideas I took from that book was that getting projects done isn't really the same as time management. So once you schedule those blocks of time like I just talked about, it's now about action management as opposed to time management. What this means is that you need to spend your time only doing the actions that will move you forward towards your goals. So you prioritize some actions and you deprioritize other actions. The important habit for me has been to break my big goals, like buying a real estate property or building wealth, and breaking them down into small bite-sized actions that I can actually do and I can actually check off on a list. I actually wrote an article that kind of explains my whole approach to that. It's called How to Transform Your Goals into Reality. And you can find that article linked in the companion article in the show description. But here's kind of a summary for now of how I suggest you do this. Number one is you identify the next projects that you need to do. So write down 1 or 2 projects that have to happen next to start your real estate investing business. And I'm pretty sure as you've listened to this entire episode, there are some things that have kind of bubbled to the top. There's some things like, all right, I've really got to do that. I've got to get financing, or I've got to choose a target market, or whatever that is. Those could be projects, choosing your financing, choosing your target market. A project, as David Allen defines, is anything that requires more than one step to accomplish. And you'll notice that this whole episode was organized into step-by-step type approach for a reason. If you're not sure about your next project, just go back to step number 1 and then make that your project. Go back to the very beginning. You can't go wrong starting with step number 1. So that's the first step here. Identify your next project. So then the next step is to identify your next actions. So actions as opposed to projects. So what you would do is you write down the next 2 or 3 actions, the things you must do. Actions are things you can do. Projects have multiple steps. So what's the next 2 or 3 things that you need to do in order to move your project to move it forward? So for example, let's say that you, as you were listening to this episode, you realized that choosing your real estate investing strategy was a big gap for you and you really needed to get that done. So that was a project. You wanted to choose your real estate investing strategy. So your next action or 2 might be to read my articles on real estate strategies. That might help you clarify and pick a real estate strategy. And then your next action after that would be just to write down the best strategy for you. Those are very specific. They have action verbs in them. Read and write. So you know a next action is a next action if it has an action verb in it. And so all you do is you write those down, you put them in your to-do list for this week, and remember, you've blocked an amount of time. So you have an amount of time for real estate investing, and you would read those articles, and you would do some brainstorming and writing some things down during your block of time. That's how it works. You can do that with any single project that you have. So then you would go to step number 3, which is actually to do those next actions. And that's pretty simple, right? You wrote it down, you blocked some time. Now you just got to do what it is that you wrote down as your next action. And then what do you do after that? You repeat and you repeat and you repeat. And so it's just a constant process. And I actually do this at the end of every single day before I go to bed. It takes me like 3 or 4 minutes. But I look at a list of projects and things I have going on. And for the next day, I write down 2 or 3 things, the next actions that I want to check off my list, the most important actions that have to get done. And then I get them done, and then I do it again, and I do it again. And so that's sort of a recipe for taking all of these big ideas and breaking them down. You know, there's always the next action to do. There's only one thing you can do at a time, no matter how much we try to multitask. And so you identifying those projects and breaking them down into little next actions is really how you take this big idea of investing in real estate, and maybe even bigger than that, of achieving financial independence, and how you turn it into the next thing that you do today and tomorrow and the next day after that. So what happens when you finish all your projects? Well, you accomplish your goals, right? And you make more goals. And so that's the way this works. You keep moving and you keep figuring out what's next. All right. So this has been a longer episode. It's been more in depth. It's been more steps, but this is a very important topic. I know a lot of you are in this boat of trying to get started or restarted. And so I hope these 9 steps that I've gone through for real estate investing 101 have given you a framework that you can both listen to again if you need to go back and review this, or you can read the companion article to get a lot out of this and to help you make progress. And that's my goal here. I would love nothing more than me spending my time doing this and recording it is all imagining that this is going to help you and get feedback from you once it does help you move forward and get started. As you may know, too much information can sometimes work against you as a newbie. That's kind of how I started this whole episode, is that a lot of information isn't always the right thing. So these action steps are what I hope you apply. Write these steps down, print the article out if you need to, and just take some next actions, get these projects done, and start moving forward with wherever you are in your real estate investing journey. Keep moving forward and avoid overwhelm, and come back to the basics, which I consider these steps of this article kind of the basics and the fundamentals of real estate investing. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI Toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI Toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I have not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.